Hello, this is Richard Pawson. It's 9:51 a.m. Eastern Time, Tuesday, August 20th, and this is the macro portion of the report. We normally will update this once a month, but occasionally we will skip a month or so. We're going to start out with a look at the unemployment rate, and I've shown this chart for a considerable amount of time here, and there's really no change to it. What we're looking at is the unemployment rate from a cyclical perspective, and what we're saying is there's a 9-year cycle for the economy. The bottom's every 8 to 13 years. We call it 9 years to just as an average or a label name. And it'll also peak out every 9 years, or basically 8 to 13 years. And it creates uptrends of a growing economy, which we call the boom trend or boom phase of the cycle, the last 7 to 12 years. And then it will create a 1 to 3 year downtrend, otherwise called a recession trend. So we get a recession once a decade, and we get at least one recession per decade. So having used this for economic indicators, we can apply it to other business statistics or economic statistics such as the unemployment rate. Because if you're going into recession, unemployment should rise. So therefore, unemployment should rise about every 9 years. Well, here's a 9-year cycle. It's rather short, and its true high was a truncated high, just a little bit lower, as of 2010. This is another cycle that's running a little more normal amount of years. Here's another cycle. Here's another cycle. Now it's a bit experimental for us because we don't have as much history for some of these economic indicators as we do for, say, prices and various fundamental inputs. But we think probably a 27-year cycle for unemployment peaked here. I don't know if that's all that important, so we're not concerned whether we've got that correct or not. Now, we also think some more significant bottoms occurred during the 2000s, okay? And they were probably related to our supercycles of when we had a 72-year cycle bottom for the stock market. And so basically the economy should grow for the next 20 or 30 years relative to those supercycles, and that should fit inside a much larger supercycle trend going all the way back to the 1930s, the true 100-year bull market, and we are in a bull market, not a bear market like some think. But someday they will be right, and we will have a 100-year bear market, although I doubt it will work to anywhere near their expectations. Okay, so let's go back here to this 9-year cycle, and we can see we had this big, aggressive explosion, the financial crisis, and the world was coming to an end. And indeed, it was coming into some of the more important cycles for the economy and stock market prices, the most important since the 1930s. So at any rate, then we did, of course, the Fed intervention, the government intervention, and bailouts and whatnot. And we can see unemployment has declined, and people have been complaining that's not declining fast enough, that the economy is not growing fast enough. Well, if you study depressions going back a couple of hundred years or more, especially if you can include Europe, maybe you can go back 500 years, and at least for the history of this nation, you find that it's not unusual for an entire decade to have complications due to a depression that might have, by some measurements, only lasted a couple of years. It was a recession that went awry. But it can have lingering impacts before and after, mostly after, and for up to an entire decade. So in my opinion, this decline is actually a little closer to normal than abnormal. And about the only way we could make that decline faster and make the economy better the way we would like it is to spend even more money, believe it or not, but not the way we've been doing it. We'd literally have to copy what they did in the 1930s and almost make people go to work, make businesses pay more money, make that money flow through the system. Now, some people at the Federal Reserve feel like that's not really necessary. That doesn't work as well as one might think either. So I think we have an attitude really from the government side, believe it or not, that they really don't want to be so liberal. They really don't want to be so anti-capitalistic and involve the government. I think those in power, the inner circle, really intended to say, just save the financial system and let everybody else sink or swim and work it out on their own. And that's going to make this slower paced recovery. Capitalism does not work very well coming out of depressions, because the depression is really a sign that capitalism broke. It burned out. It's self-destructed. So you have to rebuild it. It takes time. Well, we're doing this, And so I don't know what the answer is. All I'm saying is if you want a faster paced economy here, you probably got to have even greater intervention and support and assistance and stimulus, but you got to do it differently because it's not trickling through fast enough. Otherwise, you basically just have to say, no, hey, we saved the financial system, good enough. Now let's just let everybody work it out on their own, and we probably will. At any rate, regardless if you disagree with agree with the theory, my personal theory of how I think the economy is working, the cycles are a little more simplistic view. They're saying they don't care about the philosophy so much or what we're really doing. All they're saying is, one way or another, we will do something to make this 9-year cycle work yet again, regardless if it makes sense or not, regardless if you like it or not. We're going to do it, and we're going to make it occur so that unemployment continues to decline to this 9-year cycle bottom to about 2017 to 2019 when we anticipate a peak for the economy. Okay, so no recession to after that peak. The recession may not even show up to 2020. Okay, but we will get a recession, and it will not be a depression because we have turned the minor supercycles around to be in line with the larger supercycle. We have fixed a depression. We will not see another one until the 2030s, 40s, 50s, maybe later. Okay, so we will have a normal recession around 2020, and we'll deal with it and work with it from there. Okay, anyway, you can see this has been a correct forecast so far. We had this objective here for a 3-year cycle, and this is kind of outdated, and I'm not going to bother to update it this time, but you can see it's come down to our minimum objective unemployment, and this is behind. We're still showing 7.5 unemployment. It's even lower than that now. Okay, so basically, we're going to see this trend lower. Now, we're saying it's going to trend to 5.5, which is still not low enough for people, but you can actually have a better economy than you think then at that level. But we could even trade down to 4.5, where people would start thinking, now we're getting near full employment. Now we're getting what we want, but you might be surprised the economy still isn't as good as you think. There's various complications. This is like a transmission where there's all these gears and mechanisms and so forth for the engine of the economy and the markets. It's amazing how you can have some statistics saying things are so fantastic and you still don't get such a great economy. And you can have other statistics saying it's not a good economy at all, and everybody else says, but it is a great economy. Just fascinating how this is going to work out. At any rate, forecast remains unemployment's going to decline towards the end of this decade. We'll have a recession. We'll have a little bit of a retracement, a little bit of a correction, a little bit of a pop up in the unemployment. And then we're just simply going to put it down into late 2020s. And the 2020s economy should be better, if not much better, than the economy of the 2010s. Okay, enough of unemployment. And you can find these patterns in productivity, inflation. You can find them in markets and interest rates and real estate. The 9-year cycle is a very strong pattern for everything for our economy, even for our society and the way we think and operate. It also has something to do with people. All right, now I'm going to show you my own personal study. I call it the Eco Trend, and what we're doing is taking the ISM's Procurement Manufacturing Index, the PMI, that's released every month at the beginning of the month for the previous month, and we just make a cumulative study. If it's at 50 or higher, we add it to the previous amount, and if it's below 50, we subtract it. And the idea is to filter out some of the shorter term fluctuation, maybe some of the noise, and look at the bigger trend of what the PMI is doing. And some analysts and economists believe the PMI does reflect the U.S. economy, and I'm one of those. It works very well at keeping up with the economy. So what we're showing you is a trend that we have a recession here, and you can see these recessions do relate to cycles. This is a 9-year cycle bottom, a 12-year cycle bottom, which is still the 9-year cycle. Here's another 12-year cycle bottom. We're coming into a 9-year cycle. We had a 9-year cycle bottom for the 2009 recession, which using this indicator alone, I made a correct call within 1 month of the recession bottom. Unfortunately, I couldn't call the top because I didn't discover this to just after the top, but I believe we could have been in a month or two of calling the top for that recession. Now, what you can see is it's suggesting that the recessions do nothing but cause corrections. They are not true bear crashing end of world moments or anything like that, and there is that risk that we overreact with recessions. But it's also suggesting we work hard to manage recessions so they don't turn into crashing moments and don't turn into depressions. At any rate, what I want to show you is look at this trend of the economy growing. This actually goes back to 1950s. And it just continues to march higher, but we have these setbacks for the economy. And notice this is the least amount here on this chart compared to others. So we really did a fantastic job of containing this and keeping this from turning into a depression. And we did a somewhat good job of managing a recession. Notice how this has gone to new record highs. It's saying the economy is record large in my opinion, but it's not relative GDP showing a record fast pace by no means. In addition, this indicator seems to correlate somewhat to nominal GDP per capita, which correlates well with GDP. And nominal GDP per capita, if this indicator is new record highs, there's a good chance nominal GDP per capita is a record highs, and I believe it already is. We have not updated that in some time. So the economy is growing. It's just flat out growing. It's growing at a slower pace, and I want to caution you, I don't know if we'll ever grow as fast as we did during the 2000s and previous decades. There's some kind of pattern going on in the last 300 years that the entire world is slowing down all the time on economy. Some think that's because there's just too much debt and an expensive debt. Others think not. At any rate, we're plowing out new record highs on this indicator. It looks quite positive. But notice what it's suggesting is it probably can trend higher to 2017, 2019, and then we'll probably have a recession and it will pull back into that next cyclical bottom. Now, if we drill down, in other words, look inside what's inside the eco trend indicator, that is the PMI, and this is the raw PMI just as it's published, but I've applied cycles to it. And this was a 9-year cycle all the way up to probably 72-year cycle bottoms for the economy. You can see it crash. It was the extreme recession going towards depression. But look at the extreme recovery. Now, you'll always get this extreme recovery first out of a recession because it's really like a rate of change study. So the economy can actually get better and faster later as the PMI actually slows down. It's a little quirky characteristic. At any rate, what we think is we got a 3-year cycle bottom from 2011 going into 2013 for the economy, another one from 2011 going back to 2009 or 2008. This is 2008 for this version of this. There's other versions of this saying it's really 2009 as the bottom. So we think we now have to be bullish in the next year. Now, there's a slight chance that the beginning of this year was a 3-year cycle top for the PMI. If so, the trend is now up into 2015. The economy will grow that for that period of time relative to this cycle inside of the larger cycles that suggest the economy is growing all the way to near the end of this decade. So it's a ratcheting process. The 3-year cycle occasionally will knock us down, even though we're going to go still higher later this decade as far as growing the economy. Now, currently we're considering that maybe there wasn't a 3-year cycle top at the beginning of this year, but there was a 3-year cycle bottom this year. The trend is up to really early 2014, maybe mid-2014, and then we'll have a setback later. So it's just a matter of when, not if, we'll have a setback. But the point is it's now pointing towards concentrate on a growing economy, at least now into next year, maybe into 2015. We get this data every month. Don't be surprised. We'll see a little fluctuation, a little dip over the next few months. But I doubt it's coming all the way back below 50. And notice when it was below 50, it just immediately slammed up. It's like something was saying, no, I'm not that negative. I'm actually a strong economy that's actually growing. Now, I want to point out the Eurozone has probably returned to near 50 or higher. It's probably now seeing net growth for a change. It has probably bottomed for its recession. If it's not at 50, it's probably been up long enough to assume it's probably bottomed for recession. China eased back, but it's probably going to turn higher into next year. So we have to be bullish economy, at least in next year, if not towards the end of this decade. Thank you.